Okay, good afternoon, everybody, and welcome to this edition of our Think Learning series. This time, a crash course in crypto. Obviously, crypto is very much in the news at the moment, very new to many of our clients over here at Think Markets who may have come to us from the share trading side of things, or more specifically, the ASX share trading side of things. But it is such an amazing and interesting space. We would certainly love you to get to know more about it and potentially also, if you'd like, start to trade some cryptos with us as well. Okay, the agenda for today's presentation, really this is designed to be more of an entry level or a beginner presentation. If you are advanced, I'm sure there'll be a couple of things here that you didn't know, so stick with it, otherwise understand if you're going to go and find something more advanced. But we are trying to get you up to speed on what this whole space means, how it works, and then in future Think Learning presentations, obviously we'll ratchet it up a bit and have a look more specifically at some of the individual cryptos as well. And we have many Think Learning episodes, and obviously if you're viewing this on the YouTube site, hey, start clicking on some of those other videos on the more general topic of how to trade more generally, and that will certainly help you trading cryptos as well. But for today, we're going to talk about blockchain technology, what it is, and then how that applies to cryptocurrencies more specifically. We'll just have a look at the top 10 crypto terms, but it's going to get you across most of the stuff you need to know anyway. How to source news and charts to do your analysis, and then how to actually make it happen. Okay, let's kick off with this idea of blockchain technology, which is the underlying technology that really underpins all cryptocurrencies. Cryptocurrencies are typically blockchain technologies, but blockchain technology can be used for many other applications, not just cryptocurrency. Effectively, a blockchain is simply a database. Database is just a bunch of information. Could be, in the olden days, we had the white pages was a database. Okay, so it doesn't have to be necessarily related to currency transactions. The thing about blockchain is that it is distributed. Another way to say that is it is decentralized. You definitely would have heard that when we're talking about cryptos, or peer-to-peer. Okay, so we don't need an official body or a regulatory body sitting in the middle to make things happen for us. Okay, so for example, if we talk about the records of our driver's licenses, they are held on a server somewhere that is looked after by either a state government or let's say a federal government, to make it simple. So we've got the government looking after that database of driver's license. When it comes to blockchains, it's not the case. You can see on the image there, we've got a bunch of different computers, each talking to each other, each maintaining the ledger, and each agreeing on how that ledger will be amended, if it is to be amended. This database is public. Okay, certainly you can't go and look up your neighbour's driver's license, but this one, you can certainly see all of the people who have ever used this particular blockchain, or you see their identifiers at the very least. Really anybody can operate a node, and those nodes are distributed wherever they occur. And in the case of many cryptocurrencies, they are obviously distributed all over the world, and each node has a copy of the blockchain. Nodes are very important when it comes to blockchains, because based upon how that protocol is dictated, the protocol of the blockchain, they maintain the blockchain, maintain that database. They can propose how it is amended, as I said. They can vote on the protocol change. So the protocol that governs that blockchain can be amended from time to time, assuming you have a consensus of nodes that wish to do that. And as I said there, anyone can run a node. So it's a very egalitarian system. Each of us can be a participant in maintaining this blockchain. Next sort of step is discussing where this word crypto comes into it. Crypto is short for cryptography. And what has that got to do with the blockchain? Then we'll see what it's got to do with cryptocurrencies more generally. And let's say we have a bit of information over here on the left. So we're over here, and we have the text. This is the information we're going to put on the blockchain. I love ice cream, which is an absolutely accurate statement here. And what we're going to do is turn that piece of text, of information, into what we call a hash. We're going to use a hashing algorithm, which is just a very fancy way of saying a mathematical process. is the best way to describe it. A mathematical process that takes that information and converts it into a fixed string of numbers and letters. So the hash, and this is absolutely true, the hash for I love ice cream is actually what's on screen there. Okay. Now here's the thing. You can go from I love ice cream to the hash, but you can't go from the hash back to I love ice cream. So it's not a reversible process. But if I change any of this data here, and of course that data won't be necessarily just one statement, it could be a whole document of data. If I change even a full stop, if I change an exclamation mark, it will irreversibly change the hash of that information. And that's kind of the neat thing about this process. So we get this unique hash that represents a unique piece of information. And we're going to use words like immutable very soon, which means that for a fixed hash, you know that hash represents that information, and it will always represent that information. And any change in that information will automatically cause a change in the hash, and therefore we can see if the information has been changed in the blockchain. Okay, the other thing about this hashing business is that we can take a bunch of documents, so not just a single document. Well, I guess once we've turned these documents into hashes, we can take a bunch of different hashes that represent different bits of information, hash them again, and get a single hash. How about that? And if we changed a single full stop in this bit of information here, it would irreversibly again completely change this hash here. Okay, and once again, there's no way for a potential hacker, somebody's trying to attack the system and change this data. So the idea is that if somebody wants to change this data here, so we've got a bad person that wants to change the data here, they can't look at this hash and then infer from that hash this data. Okay, and if somehow they were to change the data here, it would result in a different hash, and we'd all know about it. So we've got this very secure way of representing information. I probably could have summarized the last slide in that sentence. It's a very secure way of representing specific information. And one little point here I probably should have made is that Bitcoin, just a note here, Bitcoin uses this SHA-256 algorithm, hashing algorithm, which is actually using a double hash. So we're hashing and then we're taking this and we're hashing it again just to be sure. Okay, so why would we do this? Well, once we've got these hashes, and these are hashes in here, for example, okay, we can bundle them together into what we call blocks. Blocks are chained together using the hashing algorithm. So all of the data in here is hashed into this one. All of the data in here is hashed into this one, okay? And all the way back to what we call the genesis block, which is the first block of information. If any data is changed anywhere along the process, it will result in a different hash. So we know that for a particular hash, the data is immutable. It is chronological. Immutable means it can't be changed. Okay, it's irreversible, is accurate. Each block has a unique identifier for all transactions in the blockchain. So each block effectively contains all of the transactions that ever occurred. And that really is amazing. Very handy for using, for recording, I should say, a ledger of transactions. So from day dot. If you think about what that means, why is that important? Why do we need to record a ledger of transactions from day dot, an irreversible ledger of transactions? Well, if you think about what's happening in your bank account right now, you've got a bunch of money sitting in there with, it might be, talking Australian banks here, Commonwealth Bank or Westpac or National Australia Bank, and there is a list of transactions back to the day you deposited that money in there. Okay, that's very important, that list of transactions, because it's a paper trail. It's a trail that tells us how much money we have at this point in time, and therefore how much money we could spend. And that's very handy, for example, for something like a currency, or a currency that you want to keep track of every holder's balance. Okay, and that's really what a cryptocurrency is. It's a technology or a store of value that uses the blockchain technology. It's simply a ledger, a record of transactions between peers, okay, between the users of that cryptocurrency. Each cryptocurrency has their specific protocol that governs the validation of the blockchain, issuance of new coins, and amendments to that protocol. Cryptocurrencies, or the protocols, are liquid. They can move, they can change depending on the wants and the needs of the users. Again, this very democratic, very egalitarian system. Compare that to fiat money, where we have no say on how that money is issued, how it is distributed, okay? And it's very hard, to be fair, with fiat money to track those transactions from day dots. A lot of people say that Bitcoin or cryptos aren't secure, but I think it's pretty clear from here that they're infinitely more secure than fiat money. So that is not a valid argument. Some examples of cryptocurrencies today. Obviously, Bitcoin is the biggest and best known. Number two, nipping at its heels, is Ethereum, but the actual currency of the Ethereum network is called Ether. And then we've got on the Cardano network, we have ADA and the polkadot token that operates on the polkadot network. And there are many, many others. There's about 9,000 different cryptocurrencies or tokens sloshing around the world at the moment. We're not going to go into those necessarily today. This is more about how they work and then how you can get into trading them. And then we'll have subsequent discussions on what each of them are and what they do and what are some of the pros and cons of those currencies. This nice little quote here from Satoshi Nakamoto. Now, you would have had to have been hiding under a rock somewhere for the last probably 10 years or so, in fact, about 12 years now, not to know who Satoshi Nakamoto is. So this is, well, actually, we don't know who he is. That's kind of the thing. So Satoshi Nakamoto is a pseudonym for the person or group of people that created Bitcoin, that created the protocol that governs the Bitcoin blockchain. And this is why they described Bitcoin, a new electronic cash system that's fully peer-to-peer with no trusted third party. Okay, we don't need a central bank to tell us what money is. Okay, so let's get to know some of these terms better. I've picked 10 of the biggest ones. They kind of all link together, and there's a few extra ones in there as well as we go. But I'm sure many people listening will have questions on what some of these things mean, what they do. You cannot own and hold cryptocurrency without what we call a cryptocurrency wallet. This is effectively just an application. Some wallets are purely software-based, so but all wallets have an element of software to them. But some of them are software-based, and they sit on your device, like your laptop, your PC, your mobile phone. And they just keeping track of your transactions on the blockchain, okay? And then ultimately, the sum of all your transactions, or the result of all your transactions, is effectively your balance. So it's quite an important point to make here about cryptocurrency in general. Is there's no physical asset that we're holding. One great thing about fiat, of course, is we can fold it, put it in our pocket, or jangle it in our pocket as well. With cryptocurrencies, there's no asset, just a record of transactions that effectively speaks to your current balance, okay? And that wallet, that piece of software, effectively keeps track of those transactions, and then can communicate to all of the other nodes in the blockchain, in the ecosystem, and say, hey, look, I'm looking to do a spending transaction, or somebody's just popped some money into your account, via a transaction. We've got two types of wallets. We can have a hot wallet is a software application on your computer or your device, like your mobile phone. It is constantly connected to the internet. That's that term hot. Okay, it relies on the security of the provider of that wallet. So it's a software application, and you can certainly go Google cryptocurrency hot wallets, and there are a number of providers out there. So it really is a trust-based relationship that you have with your wallet provider. Okay, and there are a number of obviously reputable ones out there. I'm not here to tell you what they are. Go do that search, and various services and various features that they offer on those wallets. Okay. Now, the whole point of a hot wallet is that it's really good for transactions. So obviously, if you're looking to actually spend your crypto, to actually buy real world products and services with them, or simply to trade, transact in crypto, or send to other people. For example, you might be a migrant worker in the United States from El Salvador, working over there and looking to send money back home to family in El Salvador. You would need a hot wallet to do that transaction. Okay. The reason why we talk about hot wallets with respect to transactions and not to long-term holding is because there are elevated risks with hot wallets, potentially around the trust of the party that provides that service, and also the holding of your keys. Okay, who holds your private key, which we'll talk about in a second. The cold wallet, which is the picture on the screen, okay, that's the one which is not permanently connected to the internet. Okay, so it is potentially sitting in your pocket, minding its own business until you need to do a transaction where you can potentially connect that via a hotspot to your mobile phone or your computer, communicate via the software and make a transaction, whether you're receiving, buying or paying. Okay. The great thing about this is that it is as secure as your pocket or the safe in your house or under your mattress. Okay. So you're not relying on trusting a third party to manage that for you. Of course, the downside of that is that if you've got a hole in your pocket and it falls out, or somebody breaks into your home and reaches under your mattress and takes that cold wallet, that cold wallet is gone forever. Now, without the private key, without the key that you know to access the crypto on that wallet is effectively useless to the person who's stolen it. Okay, so they would need to steal the cold wallet and your private key, we're going to talk about the next slide, for it to be any use to them. But at the end of the day, if that wallet is gone, effectively your holding is gone as well. Okay, people tend to use, what are the practical applications here? People tend to use cold wallets for long-term holding. So if you have a long-term view on a particular cryptocurrency, you would purchase that currency typically via an exchange. We're going to discuss that as well, and then you would store that on your cold wallet. Okay, for indefinitely, potentially, as long as you like. Okay, so this is where we kind of need to start talking about some of these other terms here, like public key and private key. Now, each wallet has associated with it both a public key and a private key. Public key, as the name suggests, is a series of numbers and digits. It's a hashed value. Okay, so it is again immutable. It's and very specific to that wallet. Okay, so no two wallets can have the same public key. Okay, they are absolutely unique. And when you are looking to do a transaction, or if somebody is looking to pay you for a transaction, it is the public key that they will specify in the documentation of that transaction. Okay, and the documentation of the transaction typically contains the sender, the amount, and a few other bits of metadata, and those are handled in the software of your wallet. So don't think that you need to type in somebody's public key. There are much more efficient ways of doing that, which we'll see in a second. Now, the private key is also a unique string of random characters, but this is very different. It's not hashed, it's encrypted. So this is a reversible key that it should only ever be known by you and is used to verify, or another way to say it is to sign your transactions. Your private key equals access to all of your cryptocurrencies. So be very, very careful with it. There are stories out there of this person, I think he's from the UK, who had 7,000 Bitcoin. He was actually paid them for a job. He works in IT, and he lost the key. So he's lost his private key. So he still has his cold storage device, but he has lost the private key and those Bitcoins. Imagine 7,000 of them when Bitcoin was at $65,000 US, even now, worth millions of dollars. And this particular cold storage wallet gives him a number of guesses, and of order of magnitude, I think it might have been 20 guesses, but don't quote me. He's used up a number of those guesses, trying to guess what his private key was. But as you can imagine, it's a string of numbers and letters. There's really very little chance that he's ever going to guess those. So that those Bitcoins are effectively lost to the system, and certainly lost to this person. So it's very important that you are very careful with that private key. And this is just a device here. And again, I don't want to point you necessarily to any particular product. Go do your own research. But it's called a crypto tag. And it's a bit of titanium that you can effectively stamp your private key into that. And obviously, titanium is far more hard-wearing than simply writing it down on a scrap of paper. Okay, let's talk about how we actually do a transaction in cryptocurrency. So we've got the sending wallet on the left and the receiving wallet on the right. And the first thing that should be apparent are these fancy things here, which we all know to be QR codes. So there's a very good chance that you've used a QR code in the last 24 hours, certainly last week, because they're all over the place now with COVID tracking. It's very simple. You turn up at the supermarket, you go select the app, and you flash your phone at the image, and the image has embedded within it a bunch of information that communicates to your device. And this is how we can transact using cryptocurrencies and our wallets. Obviously, we're talking about a hot wallet here, something on our device, because we're ready to do the transaction. Okay. And we would simply ask the person who we're looking to send the currency to for their QR code, and they may take a snapshot of it and send it to us. Certain wallets have this functionality built within themselves, of course. But anyway, we get this picture of their QR code, and within that QR code is situated their public key. Of course, we can never see their private key, that's theirs, but we can see their public key, so we've got their information. And then we go into our software application, and there might be an option here that says send, and within that button, I don't have obviously the picture on screen, we would choose an amount, okay, and we it's optional, to attach a fee to that transaction. And this all happens behind the scenes within our wallet software. The wallet then signs that with our private key. Now, without your private key, no transactions can occur on your part of the ledger. And we then put that out into, I guess, the universe of nodes. Okay, so the nodes, we talked about those before, are simply the computers that are constantly out there verifying the network and adding to the blockchain. So the node, and it's typically the nearest node, will verify your balance. So on the blockchain exists your balance, all of the transactions that you've done on that chain, and therefore the node can infer your current balance. So they will make sure that you have enough Bitcoin associated with the amount and the fee to be able to do this transaction, and then that transaction is sent to what we call a mempool. I don't want to get too technical here, but it's just a bunch of transactions that are waiting to be added to the blockchain. Waited to be processed is another way to say it. And ideally, our transaction eventually makes it from the mempool and hopefully into the next block. But it's not always the case. We may not be able to get our transaction into the next block, and we may not get it into the next block after that, because we will have to attach a sufficient fee to do so, because the processing nodes will typically go for the transactions that have the best bang for their buck, the best fees associated with them. Okay, and that's one of the issues associated with cryptocurrency is typically fees, and fees typically can be higher than other payment systems at this stage, but there are some fantastic solutions out there that really do minimise those fees. We're not going to go into those today, but we will do them in a future presentation. So in this case, we're sending 0.005 of Bitcoin to that wallet. And it's a great segue into the next concept, which is cryptocurrency mining, because that transaction in the mempool isn't on the blockchain yet. We haven't made that payment until that transaction exists in that immutable series of information. So how do we actually get that transaction onto the blockchain? Well, typically, I shouldn't say typically, but certainly in the case of Bitcoin, we do this thing called mining. And that is the process for adding new transactions to the blockchain by way of a block. And a block is just a bundle of those transactions. We talked about the hashing algorithm before and how we hash those transactions into a single hash as effectively the hash for that block. The block is signed, there you go, it's hashed and added to the chain. And don't forget that that hash contains all of the previous hashes that came before it. Okay, so that carries every transaction with it back to day dot. I should say that the transactions are visible. It's not to say that you can't see the transactions via the hash. The transactions are visible to everybody. So every transaction that's ever occurred on Bitcoin, for example, is visible, and you can click on that transaction and see the public keys of the people involved and the amount that was transacted between them. So the hash is not there to hide the actual transaction. It's more to identify the group of transactions and then associate those transactions with all the transactions that came before it into that unique hash, so that effectively the transactions, the details of the transactions can never be changed. They're immutable. And if there was even a full stop change somewhere, it would completely change the hash of the current block. Okay. The nodes either then accept or reject the new block, and they will compare that hash to the hashes that they're holding for the rest of the blockchain. And if everything matches up, of course, if all of the consensus of the nodes agree that this hash is valid, then that block is added to the blockchain, and the miner who was lucky enough to bundle that block of transactions, add it to the blockchain, is then awarded with a portion of the cryptocurrency. And that the amount of that portion is determined by the protocol. And for Bitcoin, for example, it varies over time. And off the top of my head, I'm pretty sure it's about 6.25 Bitcoin at the moment, but it halves every few years. Miners also earn the transaction fees associated with the block. So what's in it for the miners? Obviously, they need to do some work, and we'll talk about that in a second, to make this addition to the blockchain occur. But what do they get out of it? They get potentially awarded with coin for doing so, and also they get all of the transaction fees within the block. And there may be many hundreds or many thousands, depending on the size of those transactions within that block. Okay, and here's kind of the kicker: transactions with the highest fees versus the work processed first. So each transaction has a size or amount of information associated with it. And of course, miners will then weigh up the fee against the size of that information and the work that needs to be done to bundle that in. And unfortunately, if you want to get your transaction out of that mempool into the blockchain and therefore processed, you will need to attach a fee. How much you need to attach, your wallet generally helps you manage that process also. It'll give you an idea via the user interface of what the going rate is for a transaction of the nature that you're doing. It'll help you get that transaction typically executed as soon as possible. Okay, so don't panic about that one either. And we've just got a visual representation here of this mining process, so we can see previous blocks in our blockchain. So 2,253,532, 533, 534, and we've got the computers here all really trying or I guess racing to make block 535. Okay, and there's a couple of ways we can make this new block. I'm sure you've heard of this concept of proof of work, and this is a consensus mechanism, a way that all of the nodes can agree on the new block. Miners need to expend resources, real world resources. Okay, so we're talking about electricity, we're talking about computing power. Okay, to solve a cryptographical puzzle. Difficulty of that puzzle is set typically by the protocol, and the protocol might make it very hard to solve when lots of computers are solving it, and very easy to solve as an incentive to get more computers to solve it, more computers to support the network. Okay, if there are very few computers supporting the network, that is typically a bad thing for that network. Okay, obviously the more computers supporting it, the more stable it's going to be, potentially the faster it's going to be. So the puzzle will be made easier to entice computers to come in and win that reward. Okay, when there are lots of computers trying to solve that equation, and that was certainly the case back when Bitcoin was around 65,000, the difficulty of the puzzle automatically gets harder and harder and harder because the protocol knows there's a bunch of computers supporting the network. So it's kind of a self-sustaining incentive-based mechanism. It's very, very clever. Essentially what your computer, let's say your computer is connected to the network, and that makes it a node. If your computer is connected to the network and part of this process of mining, it is officially called a node. And your computer is effectively using its CPU to guess a number. That's what it is, effectively trying to guess a number. I'm making this really, really simple here. It's more complex than that, but we're trying to guess a number. And the more powerful your computer it is, the faster and the more guesses you can make within a period of time. And for Bitcoin, the period of time is about 10 minutes for the addition of each new block to the blockchain. So it's a bit of a race within that 10 minutes to guess this particular number. I know it sounds pretty silly that this is actually how it works, but it is how it works. And if you're lucky enough to be the one that guesses that number, you are then rewarded or awarded the right to add to bundle the transactions in the mempool and then add that to the next block. There is another way to do it. So we should talk about, I guess, the advantages of that model. The advantage of that model is everybody has some skin in the game to keep the network going. Okay, and that is very valuable in itself. One of the key disadvantages is that it's an extremely wasteful process, proof of work, because all of the computers, all of the time, are out there trying to guess a number. Okay, and if we go back to when we were in caves and chasing after woolly mammoths, if we said this would be the evolution of our series, we'd all be having computers that are trying to guess a number to make money. I think a few of us would have been surprised. But that's effectively what it is. All these computers all at the same time trying to guess this number, and it uses potentially a great deal of electricity, of power, and much of that power, unfortunately, still comes from non-renewable sources. So there is potentially a major negative environmental impact of Bitcoin mining. Let's call it Bitcoin mining. Bitcoin's not the only one with the proof of work consensus mechanism, but it's certainly the biggest. And many of you certainly would have seen in the media, because it's been all over the media, that if Bitcoin mining were a country, it would be using up about as much electricity as Argentina, but somewhere between sort of 20th and 30th in terms of largest countries' consumption. So certainly that's a negative for the environment. But having said that, much of that mining is occurring with renewable sources, hydro, wind, solar, etc. We have had a bit of a problem more recently, and that's one of the big reasons why the Bitcoin price has tumbled from over 60,000 down to around 30,000, is we've seen a big crackdown on Bitcoin mining in China. So China has this desire to be carbon neutral. Don't quote me on the year, but they certainly have a desire to be carbon neutral by a specific year and reduce their carbon footprint by a certain amount by a target year earlier than that. And they're using that as an excuse for why they're shutting down a lot of these crypto mining operations. And we had about somewhere between sort of half and 2/3, depending on what day of the week it was, of that mining was occurring in China. And probably about just over half of that again was occurring based upon coal, which is fairly cheap and easy to get, coal-fired power stations over there. A good portion was renewable. However, it's pretty much all been shut down over the last month or so. So estimates are that about 90% of China's crypto mining capacity will be offline by the end of this month, which is effectively June 2021, depending on when you're watching this presentation. So that's a story for another day. The good news is there's a better way, I think, of validating the blockchain. And there are a number of other ways, but this is probably the main one. It's called proof of stake, and a couple of blockchains that are using this technology are listed there: Cardano, polkadot. They're probably the two main ones, but there are others as well. So instead of mining, and there's really no mining at all. So there's no all the computers all the time trying to guess a number. Okay, what we're doing is here the protocol determines randomly a winner to mine that next block. Okay, and it's based upon stakes. It's based upon how much skin you have in the game. So the more skin in the game, the more incentivized, therefore, you are to maintain the integrity of the network. But it doesn't necessarily mean that if you've only got a little bit of stake that you can't be awarded with the next chain. You could potentially combine your stake with a bunch of other people's stakes as well. It's all very democratic. And then if that pool, it's called a mining pool, another commonly used term, if that pool wins that staking equation, then you'll be awarded with your portion as well. So that's all very fair. It's far less energy intensive because we're not all trying to solve the algorithm. And here's probably the key difference between the two methods is that the previous method we talked about, you do need very specific, quote unquote, mining tools to do it. So they're called application-specific units, ASICs, and they are really hardcore processing units. Whereas if you're looking at a proof-of-stake mechanism, you could operate that off your desktop PC. Okay, so that's makes potentially the system far more decentralized because you don't need to have the money, the financial resources to purchase these rigs and then run them. Potentially anybody can do that. Potentially it also comes with lower fees. It's faster as well and more scalable. Okay, starting to look at now, I guess, at how we can actually trade these things. So we've learned about how cryptocurrencies work, the basic technology behind them, how the blockchain is maintained and added to. If you're looking to get involved in cryptocurrencies, this is one of the main ways you can do it, and that's through a cryptocurrency exchange. It's simply a business that facilitates the transfer of cryptocurrencies and potentially other digital assets between its customers. Okay, so it's a little bit different from, I guess, trading with your stockbroker because your stockbroker can facilitate the exchange of your shares with another investor's shares from a completely different stockbroker. Typically with these exchanges, you're trading with other customers of that exchange, typically. But the exchange there may also seek liquidity from other exchanges as well. Okay, so that is also a possibility. Obviously, they're going to earn fee for their services, and that could be in the way of typically brokerage, but other ways they could do it, interest on borrowings and things like that. And it's as that also implies there that there are other potential DeFi services they can use. And DeFi stands for decentralized finance. We know what decentralized means, and finance is self-explainable. And wallet services, so you may have your wallet with this cryptocurrency exchange. They may put you in touch with other people on their exchange who are into mining, and you can join a mining pool. You can certainly get into staking as well, and they may also act as a financial intermediary where they're lending and borrowing. So there are people on their client base that are staking, and they've got this stake of crypto that they're not doing a whole lot with, but they'd love to earn some interest on in the meantime. And they've got people that want to borrow to invest in crypto, and literally acting as that intermediary to put those two groups together, and again taking a little bit of a fee for their service. Often seen as a conduit between fiat and crypto. So typically what we're doing is we're taking our fiat money, the kind that folds and jingles, electronically sending it to our exchange, and then converting that fiat money into cryptocurrency, which we may then hold on exchange, or we may send over to our cold wallets. And that's an example there of on exchange versus off exchange. So on exchange, we'd be taking our fiat ready for transactions, and then once we've done our transaction, we may wish to take it off exchange. Okay, but typically, if you're a long-term holder of Bitcoin, you've got it in your cold wallet, and you want to take that crypto and turn it into real-world fiat, typically you're going to take it from that off-exchange position to an on-exchange position, and then do your transaction. And there are a number of data centers and providers that simply watch that flow from off-exchange to on-exchange, because with all of these public keys we can watch this flow. There are different ones out there. So we've got a broker versus an exchange/trading platform. So some types are simply brokers where you're buying and selling the cryptocurrency directly from that company, and others, as we've discussed up to this point, are more exchange-based where you're trading with other customers of that company. And I've put the main ones on screen. Obviously, I know the biggest ones that are out there that I'm aware of anyway. I'm sure there are others, but knowing what they are, I've gone Google Images and I've grabbed their logos and put them on screen. So these are the ones I'm most familiar with, and I've been researching and in this space now for a good 5 years. So I'm quite confident they are the biggest. If I don't know about them, then they're probably not worth putting on this screen. But there are many others, and go out there and do your own research and find the one that suits you the best. Okay, so obviously we do have the ability for you to trade cryptocurrency with Think Markets, but in the interests of honesty, openness, obviously we're happy to point you at some of the bigger ones out there as well. It's up to you. Having a look at some of these other terms here, we're pretty close to the end of these. Decentralized finance, shortened to DeFi, facilitates really any sort of financial transaction that you're used to today, but doing it on the blockchain, using blockchain technology. For example, if we want to take out a loan from another holder of cryptocurrency, whether that be a financial institution or our next door neighbor, we can use various software applications to help us facilitate this and have the contracts that we're both a party to execute automatically without either party's intervention via these things which are called smart contracts. So automatically executable transactions if certain conditions are met. I did mention obviously that the decentralized applications are effectively combining a smart contract with a user interface. So, it's the old world way of having a written piece of paper that specifies what each party needs to do to meet their terms of the contract. Another thing which is quite popular at the moment, I thought I'd better put in because it's all over the place, is NFTs. That stands for non-fungible tokens. Okay, so non-fungible token. Look, it's again a way to track the ownership of a digital asset via a blockchain. Okay, non-fungible token NFT, and there's an example over there on the right. Very, very famous artist at the moment, digital artist. He only does digital artwork, and he's created that particular image there, which is a collage of a bunch of other images that he created, and he sold that via an NFT for $70 million. US. Very, very impressive. So, Picasso, Van Gogh, eat your heart out. It's probably the best way to put that. Okay, rounding out the list of our top 10 currency terms, we've got stablecoin, which is a cryptocurrency that is backed by a fiat asset or equivalent. It could be backed by gold, for example. The idea here is, and the name kind of says it all, is that this cryptocurrency is very, very stable against that asset. So for example, Tether, which is probably the best known one, its value is typically 1.000000000, and it has a very small range of movement around that, and that's the goal. That's really what you want, something that's very stable around the underlying fiat asset. So what we mean by 1.000 is that one Tether should, for all intents and purposes, always equal $1. Now, I'd say, why is that handy? Why do we need stablecoins? If we think cryptocurrencies are the way of the future, why do we need to peg ourselves to fiat? Well, sometimes you might want to just park some of your crypto assets in something that's stable. So, for example, you're smart enough to get out of Bitcoin at $65,000 US, convert that Bitcoin into a stablecoin like Tether, and sit on that balance, knowing that tomorrow you're still roughly going to have the same account balance that you did yesterday. It's not really something you can say about a lot of cryptos because it is such a volatile asset class. So typically we call these parking cryptocurrencies. We're using them until we see something that we want to do with them. Okay. Altcoins, really any cryptocurrency that's not Bitcoin. I think there'll always be this concept of altcoin versus Bitcoin. Probably hard to provide a harder and faster definition than that, because some people might say, hey, Ethereum's not an altcoin. It's the best one. But certainly there is this concept of majors and minors that we have in foreign exchange. So if you're an FX trader, you'll certainly know that majors, for example, the sterling versus the US dollar is a major, the euro versus the US dollar versus the Japanese yen, the Australian dollar versus US dollar. They're majors. And then you have minor currency pairs as well. For example, the Polish zloty would be classified as a minor. So maybe instead of Bitcoin and altcoins, we have this idea of majors versus the rest, minors. Meme coin, certainly need to know what a meme coin is. So this is quite literally a coin that was deliberately started as a joke. So it wasn't a coin that was started with all the best intentions and ended up being rubbish, and then people got on board to make it to have fun. It was deliberately started as a joke, and the best known one, without a doubt, is Dogecoin, which was based on a 2012, 2013, somewhere around then, meme, which went viral on the internet of a picture of a dog. The dog was owned by a South Korean lady, and in her best efforts at writing English little explanations of what the dog is thinking, she put some very, very funny things situated around the dog and published that maybe to her Facebook or Twitter or whatever it was. In the end, a lot of people all over the world thought it was very funny, and it went viral. And there was a young IT student, I'm pretty sure he was, or maybe a young IT professional. At the time, we thought, you know what, the world's gone crazy. Crypto was booming at the time, and he thought, this is silly. We can just make money out of anything. So he started this meme coin as an actual functioning blockchain cryptocurrency based around this dog. And more recently, it took off because it got the backing of Elon Musk. And if you don't know who Elon Musk is, go Google him. Okay. And it went from basically 0, 40, 50, maybe even 60 or 70 cents. But you can go check that out. So a value of nothing into the value of billions. I think at one stage, in fact, I know at one stage it was the 4th biggest cryptocurrency by market capitalization. And then there were spin-offs after that. Shiba Inu is another one. And the breed of the dog in that picture was actually a Shiba Inu. Let's look, it's probably actually a pretty good segue. I was going to say let's move on from the silliness, but it's a pretty good segue actually, the silliness into sourcing news and charts, because up the top we've got their social. And I think you can certainly get away if you're trading shares or foreign exchange, commodities, indices. I think you can get away with never tuning into Twitter. Okay, I think you're probably better off, in fact, having no social media interaction when it comes to your trading. Hey, this is a new world. Crypto is all about new world technology and a new generation of users, certainly much younger than you and I. And they love social media. And there are a number of influencers out there, and I've put the handles. And if you don't know what a handle is, well, number one, you're probably very old. Number two, get onto Twitter and work out what a handle is. But these are the handles of some of the biggest influencers out there. Lex Fridman isn't so much an influencer, but I like to listen to the stuff he talks about. He talks to some of the, I'm quite sure he's talked to all of those other influencers out there, so he's more of an interviewer. But Elon Musk, Pompliano, Vitalik Buterin, who is running the Ethereum project, Michael Saylor is a MicroStrategy CEO, a very famous billionaire that's getting behind Bitcoin at the moment. Charles Hoskinson, Lex Fridman I mentioned. You've got, I can't remember his name, but Bitboy there, and Justin Sundtron, they're crypto entrepreneurs. So when they speak often, certain cryptocurrencies can move, so it's worth just keeping an eye on what they do. And if you like to go that way, Reddit is another way, but it's a very diverse ecosystem there to try and find the right threads to get onto. Otherwise, for real information and updates on breaking news in the space, I like these are my picks, and you might have your own or find your own. CoinDesk, Cointelegraph, CoinMarketCap is really interesting for me because I get to see the up and comers. It's effectively the list of all of the top cryptocurrencies, the universe of cryptocurrencies, and you can then sort them by how big they are or how much they've moved. So it's a really interesting site to see what's up and coming at the moment or what's falling by the wayside. And then at blockchain.com, which also very interesting, gives you a bunch of data on the various blockchains. So how many transactions are occurring, mining hash rates, for example. It's a bunch of interesting, you can actually look at the various transactions. You can go and find your transaction on the network from a year ago if you like. In terms of charts, I think hands down, and I only put one here because hands down, without a doubt, the best is TradingView. And they do have some free packages as well, which you can get a good whack of information, so a very functional free package, but for a small amount as well, you can pay a little bit more and get some other features as well. So definitely go check them out. There's very few places because a lot of brokers, a lot of financial services companies are still on the back foot when it comes to crypto, and they just don't have the information that we would like as crypto traders. Okay, what about Think Markets? Where do we fit into the equation? Well, I think we fill a very specific niche within the cryptocurrency space. So we're not a cryptocurrency exchange. We're not a cryptocurrency broker, for example. We are not a wallet provider. We don't do any of those things. And there are some reasons behind that. What we do very well is give you the ability to trade cryptocurrencies, to trade them long and short, which is typically not something you can do with exchanges. Typically, if you're on an exchange, you are a buy-side only trader. And we know with the volatility in cryptocurrencies, that's pretty silly, isn't it? I mean, you want to be able to take advantage of moves to the downside because, let's face it, moves to the downside are often twice as fast as moves to the upside. So the way we do it is we offer you crypto trading through contracts for difference. Contract for difference is simply a way to settle the balance of a trade. Okay, so if you bet long and it goes up, however many units you've bought, by times the price appreciation is your profit, and if it goes against you, once again, that's how you work out your loss. It's very, very simple. And what they're good at is facilitating that long-short order flow. No wallets with us. Okay, so if you want to hold Bitcoin for the long term, you need to get yourself a cold wallet, for example. That's not what we're about. We're about the trading, about having an idea on direction, an opinion, typically shorter term, and taking advantage of that. So with no wallets, there are no security issues, and there really are no security issues because your money is safe with Think Markets, because we keep all of our clients' money in segregated client accounts. So if Think Markets were to ever have any financial difficulties, your money is protected and safe with your name on it, a bit like a cold wallet that is your money forever and ever. And the reason why we have to do those things is because we are regulated by the Australian Securities and Investments Commission, otherwise known as ASIC over here in Australia. But because Think Markets is a truly global company, we are regulated by the American regulator, the UK regulator, and a few others around the place as well. So to meet those conditions, obviously you need to strictly adhere to the various regulations of those various countries, and you are very closely scrutinised by those regulators. So I think there are some real advantages in terms of doing it through us if you are looking for that niche of, I just want to trade. I'm already a trader potentially. I've got my own trading system. I'm not interested in all of the risks that go into crypto exchanges, because let's face it, there have been a number of major hacks of crypto exchanges where customers of those exchanges lost all of their Bitcoin holdings. Okay, that's impossible to occur with us. So if you are just looking to trade, in my opinion, this is the best way to do it. Listed on the right-hand side there are a few of the Bitcoin, a few of the cryptocurrencies, not just Bitcoin, that we offer, and obviously using the trading applications that we have, you can get the charts that you need. Okay, you don't need to go to TradingView, and on those charts you have all the indicators and all the analysis that you would ever want to have. So how do we do it? Head to thinkmarkets.com. It will typically take you to the site, depending on your geographic location. Your browser typically knows where you are. It'll take you either to the Australian site, the US site, the UK site, the South African site, etc., etc. And there's a big green button on there. Invariably, whichever site you go to that says create account, click on that. And in literally 10 minutes, you can have your account funded, and you can be long or short Bitcoin, Ethereum, Cardano, polkadot, Solana, Polygon, whatever you like. Okay. Well, that's it for me today. Again, this was just meant to be a good solid foundation on what the space is, some of the functionality, how it works, and we will no doubt in the very near future move into a further investigation of some of those different cryptocurrencies. What are the benefits? What are the disadvantages of them? Why you might want to own them for the long term or trade them in the short term. But for now, I can direct you to the market news section of our website for all of my news, views, opinions, updates, charts, and the like. And you can also follow me or the Think Markets handles on Twitter. Don't forget, if you're watching on YouTube, make sure you click on the little thumbs up button as well. Make sure you like us and subscribe for further videos. You can register for the videos and be part of what ends up being the videos in our webinar section of the website. There's the link down there. We've got a few upcoming. That's a little bit of a giveaway of when this was recorded if you are watching on YouTube, and you can register for any of those. And we do always have very interesting webinars for you to participate in. This is going to be a very interesting one here, the Turtles trading strategy. We'll go through step by step the very famous trading turtles who made $175 million in the 80s using this system. That's going to be a good one. Okay, the disclaimer before I leave you says that everything we've discussed today is general in nature. We're talking about ideas, information. Before you actually act upon that, you need to consider whether it's relevant for you. As a regulated Australian broker, I must say we do have some products that could see you lose more than you deposit, so it's important that you read and understand this disclaimer carefully. And if you have any questions, please give us a call. Always happy to chat. That's it for me today. I hope you enjoyed the presentation. All the best until we catch up again. Bye-bye for now.